New York has always been a city that moves to the rhythm of money. Its skyline isn't just made of steel and glass. It's made of credit, of debt, of promises that stretch decades into the future. Every tower, every condo, every brownstone owes its existence to the quiet machinery of banks. But in 2025, that machinery is beginning to seize. It starts not with a crash, but with hesitation. Mortgage applications fall, refinancing slows. The flow of capital through Manhattan's arteries starts to clog, not from panic, but from fatigue. The city feels it before the rest of the country does, because New York doesn't just host finance, it is finance. And when the bankers begin to whisper, the whole world listens. JP Morgan Chase's headquarters on Park Avenue still gleams like a monument to confidence. But behind closed doors, executives are uneasy. Their real estate loan portfolio has swollen over the last 5 years. Commercial mortgages, multifamily loans, leveraged financing to private equity landlords. For years it all looked safe because prices only went up. Vacancy rates were temporary, defaults were contained. That illusion is breaking. Across the city, entire floors in new luxury developments sit dark. The high-end market has frozen, not because buyers disappeared, but because their faith did. The idea that Manhattan property was immune to downturns has finally died. Developers call their bankers. Bankers delay their responses. Credit committees meet late into the night, reviewing exposure maps that glow redder with every new report. Wells Fargo, still recovering from years of scandals, finds itself overextended again. This time not from fake accounts, but from real buildings. Projects in Hudson Yards, Midtown East, and the financial district are no longer generating enough cash to meet their loan covenants. Quietly, the bank begins selling off portions of its debt to hedge funds, hoping to reduce risk before the storm becomes public. But the hedge funds know what's happening. They demand discounts, 30%, 40%, sometimes even 60%. That's when the panic begins. Citi faces its own reckoning. For years, the bank aggressively expanded its commercial real estate lending to compete with private lenders. Now, those same loans, once celebrated in internal reports, are liabilities. The value of the collateral has evaporated faster than anyone predicted. A 50-story glass tower that once appraised for $600 million is now barely worth $350 million. Citi holds the note. The borrower wants to walk away. By autumn, the cracks become visible on Wall Street's surface. Analysts begin to ask dangerous questions during earnings calls. How much exposure does your bank have to office loans? What percentage of your mortgage portfolio is delinquent? CEOs offer vague answers about resilience and diversification, but behind the scenes they know the dominoes are lined up. The first one to fall might be regional. A smaller bank in the Midwest, heavily invested in multifamily developments, reports unexpected losses. Its stock plunges 60% in a single day. Investors flee to safety, pulling deposits from other mid-sized lenders. The contagion spreads through whispers, through screens, through fear. And in New York, the big banks feel the tremor under their feet. In lower Manhattan, the mood turns heavy. Traders speak in low tones. Journalists at Bloomberg and Reuters begin calling their contacts at the Federal Reserve. Everyone senses that something familiar is unfolding, though few dare to say it aloud. The last time banks began to quietly offload mortgage debt, the year was 2007. Everyone remembers what came next. The difference this time is that the threat isn't subprime households, it's prime towers. Office buildings that once generated millions per month in rent now stand half empty. Corporations have downsized. Remote work never fully vanished. The hybrid model became permanent. What used to be a temporary shock has hardened into a new economic reality. Fewer workers in offices, less foot traffic, less demand. And that single shift has destroyed trillions in projected value. At Goldman Sachs, analysts run models showing that even a 15% decline in commercial property values could erase billions in bank capital. The number isn't theoretical anymore, it's already happening. The banks hold the loans, the investors hold the bonds, and the regulators are watching it unfold in slow motion. Meanwhile, in the city's outer boroughs, another kind of crisis brews. Landlords who refinanced during the low-rate era of 2020 now face renewals at rates twice as high. Their buildings, some in Brooklyn, others in the Bronx, can't sustain the new payments. Tenants are leaving. Rent prices are softening. The math no longer works. The landlords default, and once again the losses flow back to the banks. It's a feedback loop. The more defaults, the tighter the credit. The tighter the credit, the more defaults. The cycle feeds itself like a machine designed to implode. The Federal Reserve begins to issue cautious statements about stability risks in the real estate sector. Jerome Powell insists the system is resilient, but even his tone betrays concern. The Fed has raised rates to fight inflation, but those same rate hikes are what's killing the real estate market. Every percentage point higher pushes another property underwater. Inside JP Morgan's risk division, analysts begin reviewing their largest borrowers. One name comes up repeatedly: Blackstone, the world's largest private landlord, sitting on billions in real estate debt, much of it now underperforming. When even Blackstone pauses distributions on its flagship real estate fund, it sends a shock through the market. If they're worried, everyone should be. At the same time, New York's skyline becomes a metaphor for the crisis itself. From the street, the towers still look magnificent, glassy, immaculate, eternal. But look closer, and you see the signs of decay. Empty lobbies, unrented floors, cleaning crews reduced to part-time. Buildings designed for 10,000 workers now operating with 2,000. Bankers, once symbols of confidence, now walk through those streets with quiet apprehension. They see not just lost revenue, but reputational danger. After 2008, they were supposed to have learned. But the new collapse is built on different ground, one they never expected: value erosion without defaults, a system collapsing not because of reckless lending, but because the world itself changed faster than they could adapt. By winter, the numbers tell the story that words can't. Commercial delinquencies reach 9%, the highest in a decade. Office vacancies in Manhattan crossed 22%. And for the first time, the phrase "zombie tower" becomes common in financial reports. Behind the scenes, a handful of executives begin discussing solutions: loan restructuring, mergers, government backstops. But there's no consensus. Each bank hopes someone else will blink first, someone else will fail first. Because once that domino falls, the rest have no choice but to follow. In early December, an internal memo leaks from the Office of the Comptroller of the Currency. It warns that systemic risk related to commercial real estate exposure is elevated. Within hours, the memo circulates across trading desks worldwide. Stock prices dip. CNBC runs the headline, "Are US banks sitting on the next real estate time bomb?" The question isn't rhetorical anymore. Late that night, in a dimly lit apartment overlooking the East River, a financial analyst stares out at the skyline. The view still looks indestructible, but he knows what the spreadsheets show, what's hidden beneath the lights. The towers are bleeding value, the tenants are leaving, the loans are deteriorating, and the balance sheets, the ones holding it all together, are beginning to shake. The next morning, the markets open quietly, but the system isn't quiet at all. Deep inside the vaults and servers and balance sheets of the nation's largest banks, a chain reaction has already begun. The first domino has fallen. By the start of 2026, the fear that once lived only in analyst briefings begins to spill into the public conversation. Financial journalists call it contained turbulence. Economists use phrases like sectoral correction. But on Wall Street, the language is simpler: Nobody knows who's holding the worst loans. Inside J.P. Morgan Chase, a quiet revaluation begins. Assets are being marked down, portfolios rewritten. A year ago, these buildings were collateral worth hundreds of billions. Now they're liabilities sitting in limbo. Midtown towers once leased to tech companies have become glass fossils of a vanished boom. Even the banks can't find buyers for the debt. For a moment, it feels like déjà vu. 2008, all over again. But this time, the crisis isn't built on reckless consumers. It's corporate, institutional, invisible to most Americans until the layoffs start. Goldman Sachs and Morgan Stanley see what's coming and pivot fast. They begin shorting commercial mortgage-backed securities, the same strategy that made fortunes in the last collapse. This time, it's not greed, it's survival. Hedge funds follow, smelling blood in the water. Markets that once moved in predictable rhythms now twist and convulse with every new report. Wells Fargo announces higher loan loss provisions. Citi's CEO, under pressure, assures investors the bank is positioned for resilience. Behind the optimism, internal memos paint a different picture. Loan defaults accelerating, valuations sinking, liquidity thinning. On conference calls, analysts press harder. Are you expecting further write-downs? The answers grow vaguer with each quarter. In Washington, regulators debate intervention. The Treasury Department quietly assembles a task force, while the Federal Reserve explores emergency liquidity measures. The message they want to project is confidence, but even they know confidence isn't policy. The real question is how many dominoes they can catch before the rest fall. The contagion spreads beyond real estate. Construction firms tied to commercial projects begin to fold. Steel and glass suppliers cut production. Thousands of electricians, carpenters, and cleaners lose their jobs. The financial system bleeds into the real economy, quietly, relentlessly. In Manhattan, empty luxury towers rise like monuments to a vanished optimism. Billion-dollar projects now sit half-sold, their marble lobbies echoing in silence. Investors from Hong Kong and Dubai no longer call. Foreign capital, once the lifeblood of New York's skyline, has vanished. And then comes the headline no one wanted to see. Regional bank files for bankruptcy, largest failure since 2008. It's a mid-sized lender out of Illinois, but its balance sheet is full of New York exposure. Within hours, depositors across smaller banks begin to panic. Shares plunge, the FDIC steps in, and suddenly everyone remembers how fast trust can disappear in the digital age. The collapse sends tremors through the credit markets. Bond yields spike, and the cost of financing doubles overnight. Developers already struggling to refinance now find themselves trapped. Some begin to surrender their buildings to the banks. Others vanish into bankruptcy court. The ownership of New York itself begins to change hands again. By spring, the bank domino has become a global story. European regulators express concern about U.S. real estate contagion. The IMF releases a statement urging coordinated stability measures. The White House convenes an emergency economic council. The tone is serious but late. The damage is already embedded in balance sheets. For ordinary New Yorkers, the crisis feels distant, until it doesn't. Condo prices begin to fall, mortgage approvals tighten, home equity lines vanish. The trickle-down effect of financial tightening hits renters, small landlords, and first-time buyers alike. In Queens, a family trying to refinance their modest home is rejected without explanation. In Brooklyn, landlords delay repairs because banks have frozen their credit lines. On the 30th floor of a midtown skyscraper, a team of J.P. Morgan executives meet to discuss options. One proposes consolidating exposure into a bad bank, a vehicle to isolate toxic loans. Another argues for government guarantees. The CEO listens silently, staring out at the skyline. He knows none of these are real solutions. They're containment strategies, and containment never lasts. Meanwhile, whispers circulate that Bank of America might be next to face a liquidity crunch. It isn't true, yet, but rumors have power. Traders start selling their shares. Social media amplifies panic faster than any official statement can calm it. In a single day, 40 billion in market capitalization evaporates. When the Federal Reserve finally intervenes, it does so with familiar tools: emergency lending, rate cuts, liquidity injections. The markets rally briefly, but the underlying reality hasn't changed. The loans are still bad, the buildings still empty, and the tenants still gone. Monetary policy can't refill towers or reverse migration. The narrative begins to shift. Economists start using new phrases: the structural correction, the great repricing, the urban reset. The meaning is the same. The old system is dying. The age of infinite debt and ever-rising property values has ended, and no one knows what comes next. Across the East River, from a high-rise in Long Island City, a financial journalist watches Manhattan's skyline at dusk. The towers still shimmer, but the illusion is fading. He writes the first line of his report: New York's banks are not collapsing. They're transforming. What we're witnessing isn't the end of the system, but its mutation into something colder, leaner, and less human. By summer, the transformation is complete. The largest lenders merge or consolidate. Thousands of bank employees are laid off. Branches close. Risk divisions expand. The age of growth gives way to the age of defense. The ordinary New Yorker won't see this shift immediately, but they'll feel it. Fewer loans, higher rates, stricter terms. The city that once borrowed its way to greatness now finds itself under financial quarantine. And still, in the heart of Lower Manhattan, the lights of the financial district glow each night as if nothing has changed. But behind those windows, the conversations are different. They're quieter, sharper, tinged with memory. The men and women who once believed they controlled risk now understand they were only managing delay. What began as a real estate slowdown has become something larger, a reckoning with the fragility of belief itself. Banks don't fail because they run out of money. They fail because they run out of trust. And once trust disappears, every balance sheet becomes fiction. In the end, the dominoes didn't fall all at once. They fell slowly, precisely, one after another, until the picture that once looked solid, America's financial fortress, was revealed to be made of paper. As the camera drifts over the city at night, the skyline reflects on the river like a ghost of its former self. New York is still standing, the banks are still standing, but the foundation has shifted. And somewhere in that glittering silence, a new question begins to form, one that no economist, no banker, and no regulator can yet answer. If the system has survived every collapse before, what happens when it finally runs out of illusions to sell?